Hi, everyone. Welcome to today's webinar, The Metrics That Should Be in Your Pitch Deck. I'm Gabby Bubba, Growth Marketing at Atrium, and your moderator for today. Before we dive into webinar logistics and our speakers, I want to tell you a little bit about Atrium. Atrium is a services and technology company providing startups with expertise and support to grow and scale. We've designed our Startup Concierge service to cover the most common startup needs so that you can receive premium resources, expertise, and coaching at an affordable price. Today's webinar, it'll run for about 45 minutes of content and 15 minutes of Q&A at the end. Feel free to submit questions at any time during the presentation on the left side of your screen. And now I'll pass it over to our speakers for today, two members of the Atrium Fundraise Concierge team, Kirsten and Jimmy, to introduce themselves and dive into the content.
Hi, everyone. I'm Kirsten Bernhardt. I'm Head of Investment Strategy with Atrium's Fundraise Concierge team. I am a qualified chartered accountant from Australia, and I've been a trusted business advisor for working with global consulting companies, KPMG and EY, as well as a range of startup advisory groups and venture funds. In my role with Atrium's Fundraise Concierge Group, I help startups with their fundraising process management, and financial modeling.
Perfect. Thanks so much. Hi, everyone. My name is Jimmy Koo. I'm the General Manager of Fundraise Concierge. A little bit about my background. I've seen fundraising from a variety of different angles. I've been a founder. I've raised millions from my previous startups. I've also been an investor and an advisor. And prior to coming to Atrium, I ran a frontier technology accelerator focused on all kinds of things like AR, VR, AI, ML, and a bunch of other buzzwords. I helped the 40 startups in the accelerator raise over $130 million 2 years ago, and our Fundraise Concierge team has helped our clients raise over $200 million last year. And really excited to talk to you guys about what we've seen with the companies that we talked to. We've talked to hundreds of startups on a monthly basis, and one of the things that's truly important is just how important the numbers are to the story and the narrative that people present. So we'll go ahead and dive right in. What we're going to be talking a little bit about, there are a few large buckets of conversation that we're going to go through. One is the traction that you have as a startup and how important that is, and what are some of the things that you're going to want to talk about and make sure that you point out as part of your narrative. The second is your growth and your metrics and how you can properly forecast that growth in a way that's realistic and in a way that the investors can understand, comprehend, and see the potential for your startup. And the third is, what is it that you really want? How much money do you really want to ask for? And why are you asking for that? And ultimately, how are you going to then use the funds?
Excellent.
I think we're seeing a couple of things where folks can't hear very well. Is the sound okay? I just want to make sure that Gabby and Kirsten, you guys can hear okay, right?
Hey, yeah, we can hear you all right on our end. We actually just refreshed our internal microphone because it was a little choppy for people on the line.
Got it. Okay. I just want to make sure it wasn't
yeah.
Perfect. All right. Well, let's dive in a little bit. So the first part, there's a tweet that was sent out by Andrew Chen from Andreessen Horowitz, and I think it very perfectly encapsulates the importance of the various numbers as your company grows and as you get into the further rounds. So when you're talking about a seed round of fundraising, you're generally talking to angel investors or early stage investors, and generally the investors are betting on the entrepreneur. You haven't really built anything yet, and you don't have a lot of metrics to show at the moment, but there are still numbers that can be provided that help build the story for what your company is doing and how you intend to take over the opportunity ahead of you. What is the problem? What is the solution you're going to be providing? And ultimately, why are you the right team to go focus on that? But really early on in the process, the investors are betting on the entrepreneur. Now, on the seed stage, maybe there's a little bit more, so you're betting on maybe the team that's been built, a little bit of what a few steps towards the ultimate goal that you are going towards. But as you get into Series A, Series B, and Series C, it starts becoming more and more about the numbers that you do have and how it showcases that what you're doing is working. So as you get to your Series A, typically you've showcased a little bit of traction. So what is that traction? What are the metrics that show that you are building something that people really want? Typically the term that folks talk about is product market fit. How do you showcase that you do have product market fit from the traction that you've received? And then as you grow further for your Series B, it generally is more about how are you going to grow that further. So your Series A, you've shown that there's some traction. That's great. For your Series B, you're typically showing that you're going to grow. So how are you going to grow? And is it a growth of your revenue or customers? And how do you intend to do that? And then for your Series C and beyond, you're typically talking about growing a long-lasting business. So what are the unit economics, and how do you really showcase that what you're doing is a business that has legs and will stick around for a very long time?
Excellent. And I wanted to, build on what Jimmy was just talking about and what Andrew Chen mentioned in his tweet by sharing a story from one of the fireside chats that I listened to at Startup Grind a couple of weeks ago down in Redwood City. The fireside chat was with Jennifer Hyman, who's the founder of Rent the Runway, and she was speaking with Aileen Lee of Cowboy Ventures, but Aileen was previously a partner at Kleiner Perkins, and Kleiner Perkins led the Series B round in Rent the Runway. And Aileen said one of the major factors as to why she decided to support the Series B investment in Rent the Runway was because when Jennifer pitched, it really stood out how well she knew her numbers in her pitch. It was very evident to the partners at Kleiner Perkins that Jennifer had kind of really thought through a number of different scenarios for the business, had modeled those scenarios out in a financial model, and had a number of appendix slides which could quantify and preempt investor questions. So that confidence and that knowledge in the financials and in the numbers of Rent the Runway really supported Jennifer in securing her 15 million Series B for the company a few years ago. So I think that's just one example, and we have plenty of examples where it can speak to how important it is for founders to be confident in their numbers. And that's what we're going to talk about today, is what the key numbers are and how you should be thinking about them and presenting them to investors. So the first one I wanted to talk about is total addressable market, or TAM. TAM is so important to understand as part of your business because it really speaks to how big is the problem that I'm solving. So how big is the key problem that you're really going after? And that's important to investors because the nature of venture investing is such that, that investors are typically looking for unicorn opportunities. And in order to be a unicorn of a business, you need to be attacking a huge TAM. Okay, so you need to be thinking about TAM in the billions rather than the millions to be stand out as a potential venture opportunity. If you think of a market, obviously your company and your revenue is only going to represent a fractional percentage of that total addressable market. So it's very important to understand total TAM, but then also be realistic about what fraction of that TAM you'll be able to secure as your company scales. There's a couple of ways to think about total addressable market. I'll give you an example. One is a top-down approach. And in the top-down approach, you might think about packaged food as an example. The packaged food market is an $800 billion market. If I have a company in the packaged food market, I might say I'm trying to secure 1% of that market, and then I will be an $8 billion business, right? That's a very rudimentary way of thinking about total addressable market and the opportunity for your company, and it's not super defensible. As an alternative strategy, you can think about it from a bottom-up approach. Bottom-up is definitely more defensible, and that's where you start to look at the number of potential customers and the value of those potential customers, start to model out your total addressable market in terms of a much more level of detail. If we think about two examples of total addressable market, one of them is direct-to-consumer company Dollar Shave Club. Thinking about their TAM, you could think about, are they in the personal grooming market? Are they in the male grooming market? Are they in the hair removal market? Are they thinking about the US market relative to the global market? So there's that's just some examples, but there's a number of factors that you might think about when trying to understand the total addressable market for Dollar Shave Club. As another example, if you're operating a company in more of a frontier technology space, something like SpaceX as an example, you may not really have it may be a lot harder to understand your total addressable market because you don't really have an existing market to model from. Technology often means you're creating a new market space, and therefore you have to make some assumptions around technology adoption and growth to estimate a total addressable market. So if you think about SpaceX, they use some proxies for their TAM, including, expenditure on space exploration, and also expenditure and demand for high-end luxury travel is one area they also looked at. And the reason for that is because they're trying to, bring space travel to very, very wealthy individuals. So it's just a couple of examples of how you might think about your total addressable market. And just to reiterate, it is so critical to understand your TAM because it quantifies how big is the problem that you're solving.
Yeah, absolutely. And I just wanted to add a couple more things to the TAM discussion real quick. The total addressable market, in some cases, you're building something brand new. And so it's not just one or two markets, it's a combination, or it's possibly something new. So one of the examples, one of my previous companies was part of TechCrunch with Fitbit, Yammer, TrueCar, Dropbox, and several others. And Fitbit, when they were going out there for fundraising in the early days of wearables, they were talking about what they were building, which was originally a wearable that helps you when you go to sleep and in tracking kind of your sleep patterns. Now, the problem was the wearables market didn't exist. So they went out there during a recession talking about a wearables market that didn't exist yet, and so had a really hard time trying to get investors to believe that this was going to be a huge opportunity. It ended up being, a very difficult fundraise for them, but they did get a $2 million seed round, had to give up a good chunk of the company for that. And obviously we all know that the Fitbit story was a pretty successful one where they built that product, were able to IPO that, and also recently got purchased by Google. But that first investor had to believe that the total addressable market for wearables was going to be a large market, and some people didn't believe that. And so a lot of investors passed on them in the early days because, how big is the wearables market? If you get 10% of a $200 million opportunity, what does that really mean? And what am I going to get if I make an investment in you? Another example is the early days of Uber. Uber was talking about transforming mobility and transportation. But everyone in the early days just thought of them as a proxy for the taxi industry. If you were to just address the taxi market opportunity, then what is it that you're going to what can you possibly be worth, right? You're really talking about a percentage of what the taxi market opportunity is. But you think about changing the landscape of how people actually transport people and goods and all kinds of other things, and changing how people move around, then you're talking about a much larger opportunity. You're talking about car ownership, you're talking about buses, you're talking about all kinds of different things, delivery. And so it's really helping the investors see the larger opportunity in how the market could actually change and how you can address that changing landscape as well.
Okay, thanks, Jimmy. The next one we're going to talk about in terms of key financials to represent when you're pitching to investors is traction. So some of the, actually I'll start with why traction is so important. Traction is essentially a proxy for whether you have product market fit. Okay, so traction, one of the easiest ways to measure traction in most companies is by revenue, and in particular, month-over-month revenue growth. That's a very nice, easy, metric to quantify and to look at. However, revenue is not always the best measure of traction, and an example of that is Facebook. In Facebook's early days, the success and growth of Facebook was not measured based on how much revenue they were generating. It was actually all about user growth. And so you need to understand, for measuring traction that's relative to your business, what that actually means to support whether you found product market fit. So if you're a business like a Facebook or a user-based business, you might think about active user trends and whether that's daily active users as a percentage of monthly active users or monthly active user trends. If you're a subscription business, you might think about non-monetary metrics such as number of new subscribers. If you're a SaaS business that's offering a freemium model for customers to get people in the door, you might think about traction in terms of how many of your customers you're converting from the freemium model to the paid model. So Dropbox is a perfect example of this. In their early days, and they actually have still struggled with this, but in the early days of true traction of the business, it was one measure to show they had a lot of users under the freemium model, but then it was another, much more telling metric to be able to demonstrate, can they convert those freemium users into revenue generating customers? So think about, the traction for your company in the absence, obviously revenue is the best measure, where it makes sense, but in the absence of revenue, if you're early or you're perhaps not focused on revenue as your core measure of success in the early days of your company, think about what metric demonstrates that you have built something that your customers want and that you can show you've got some product market fit that's trending in a positive direction. The next thing on this slide that we want to talk about, which is so critical, is customers. So while traction, really demonstrates or can be quantified in terms of how many customers you might be servicing, thinking about other metrics to explain the quality of your customers is really important as well. So when you think about the quality of your customers and whether you understand the quality of your customers, you might think about metrics including customer retention and how sticky your product is and how much churn you have with the customers that you're bringing on. You might think about customer acquisition and different marketing channels. So how are you actually acquiring new customers, and is that effective for you? And in terms of your customer acquisition cost, are you investing money to acquire new customers in a cost-efficient and capital-efficient manner? In terms of the customer value to you, you might think about measuring and tracking average revenue per user, so ARPU. If you're a SaaS business, you might be thinking about your average contract value for the customers. For a direct-to-consumer business, you might be thinking about average order value per customer. And then, of course, lifetime value. Customer lifetime value is an important measure. And so lifetime value is looking at, the monthly revenue from your customer and how many months that customer is a customer of yours. And you may be familiar with a ratio that you see a lot and investors really talk about a lot, which is your Ltv to CAC. So that's your lifetime value of your customer compared to your acquisition cost of your customer. Obviously, this is an important metric because you want to be able to show that the money you spend in marketing to acquire a customer is less than the lifetime value that customer generates for your business. In the early days, it's very difficult to really generate a robust Ltv to CAC because you're experimenting with different customer acquisition channels. You perhaps haven't got enough length of time to truly calculate a lifetime value of a customer. And so your Ltv to CAC ratio becomes more and more important and robust as your business becomes more and more mature and you've got a proven customer acquisition process and sales cycle. Some other elements in terms of customer traction or customer metrics that are important are things like your NPS score, for example. So are you surveying your customers and getting feedback around, whether they like your product, would recommend your product? Although these are not financial metrics, they are still quantifiable customer data points to really demonstrate that you understand your customer and are delivering value to them. So just to reiterate, the quality of your customers is an important measure as well as the quantity of your customers. So make sure that you're understanding both of those things. And in terms of direct-to-consumer or SaaS companies, there are a range of data analytics tools that you can use in your business. Looker, Tableau, Segment, Profitwell are some examples. It depends on what's the right fit for your business, but having a data analytics tool that can really track and measure customer acquisition costs, customer retention, and customer value metrics is really important and something that investors are very, very interested in to make sure you understand your customer trends.
Yeah, and I'd just like to add another story about the customer traction. We had a client that we worked with for Fundraise Concierge, and as we started digging into the narrative and their financials, just to give some background, this client creates mobile applications. And so as we dug into the numbers, there were several mobile applications that they had. One of the ones that was most successful for them was a mobile application that focuses on music. They were creating one that was now focused on video, and they had a bunch of other applications as well. But when we dug into the numbers, we were seeing that their revenues were actually really driven by one of their applications, which is more kind of like a game, but it was like a sweepstakes/game type application. And so even though the company had a lot of customer traction on both the music application and also the video application, the revenues were really actually primarily driven by this kind of subscription application that they had. And so from that, what we were realizing is that the customer base that they had on that application was the most profitable, but it wasn't that the customer base was significantly different. It was just how people were interacting with the tool and the application. And so what they had built actually could be applied to their larger customer base in the music application and also the video application. And so they decided to then pursue changing that kind of subscription and gaming application, making it as a widget that they can apply across all of their other applications, which allows for them to monetize better.
Excellent. I think that's such a good example of making sure you understand your customers and which elements of your customers are generating revenue for your business. The next thing that we want to talk about is the ask and use of funds. So assuming that you have mapped out and quantified, your total addressable market, and it's an exciting and big enough problem that you're targeting, you've got some early traction that is quantifiable, you're tracking your customer data points, and can really demonstrate that you know your customer, then next thing you're thinking about is how much you want to raise and what you want to use those funds for, how you want to deploy that capital efficiently in your business. Now, in terms of fundraising, there's a couple of anecdotes. One of them, as a founder, fundraising is always top of mind, I think. And it's either driven by you wanting to raise as much as you can and not turn away any eager investors interested in coming into your business, or the other driver is raising whatever someone will give you. Now, while those two may play out as reality more often than not, what you actually want to have underpinning your strategy for fundraising is something a little more robust in terms of how much capital you want to raise, so that's your ask, and then how you're going to use that money within your business. Now, this is an important thing to think about because as you go into your conversation with investors, because the amount of capital that you raise impacts your valuation and impacts future fundraising rounds. An example I can give you is I just spoke with a company last week in the crypto space. They're a very early stage company that raised a substantial amount of money very early on, took the capital because the capital was available at the time, but are now having some challenges with a follow-on raise because it's a difficult signal to the market. If you raise a large round, investors like to see that your next round is typically going to be larger than your last round because you're constantly, it's a good signal that you're growing your business. And therefore, with each stage, you want to be raising more capital. Now, because this founder took a large round early on, they are now thinking about how do they justify an even larger round for their follow-on round, and are having some challenges around what that means for dilution and for actually how they use that capital in their business. So it can create some challenges for your cap table and for your investors if you get the raise, the ask wrong and you raise too much money. Now, the flip side to that is if you don't raise enough money, it can also cause challenges for your business because you can find that your runway is not as long as you thought it was and you are actually running out of cash. And the next time you go to investors, you don't want it to be raising money because you're running out of cash. You want it to be raising money because you want to fuel growth and continue on your path to profitability or to scaling your company. So super important to at least have some strong opinions around what your ask is, how much money you want to raise, and how you're going to use that capital. In terms of how you're going to use the capital, investors will be very interested to understand what the next inflection point in your business is. So if you're raising a Series A, for example, how much capital do you want to put into your business to get you to be investable for a Series B, which is presumably the next round you'll raise afterwards? What is it that you want to achieve with that capital that you're raising in your Series A, and how much do you need to invest to get you through those milestones and ready for to get in front of Series B investors. So typically what we see in terms of use of funds, we see capital being deployed for scaling a sales team, for investing in paid marketing channels if you're going after customer acquisition, for product development if you're, iterating on new versions of your product, for new market entry if you've tested in certain regions and you're now expanding nationally or internationally into new markets, for working capital in some cases, for example, a direct-to-consumer business that may have high inventory costs. Some investment may be required to support the working capital of the company. But as a founder, it's important for you to be able to reconcile what your ask is and how that money will be spent. And as part of your narrative, you need that to be you need to be able to demonstrate that the money is going to be deployed across value-generating areas. So, if I give you $10 million as an investor, can you show me that if you put that into your sales team, that $10 million will generate more sales, more revenue, higher valuation? If if I give you $3 million and you want to put it into product development, can you show me that, through your modeling or through your thought process, that $3 million invested in product development will lead to new customers, more revenue, growth of your business? That's the story that you need to be able to tell when you're thinking through how much money to raise and how you're going to use that capital. Jimmy, did you have anything to add to that?
Yeah, absolutely. So a couple of examples of how the ask and the use of funds really tie back to the narrative and how important it is. One of the companies that we worked with is a little bit of an earlier stage company. The founder's done it before, has a lot of experience in that, but he wasn't sure if he wanted to raise a seed or a Series A or even how much. And this might happen as you're talking to your friends and talking to investors. Some investors were coming in and saying, hey, you should raise $5 million, $3 million. Some friends were saying you should raise a seed round, $500,000, $1 million. And the founder wasn't really sure and was going out there and having conversations with folks, and his ask was constantly changing. Now, that doesn't make you look good. If you don't know what you really need or what you really want or what you're seeking, it's going to be hard for the investors to want to put money into your company. And so one of the things that we went through as we talked to him about his considerations and his strategy was that actually he hadn't raised anything yet. He was bootstrapping everything because he'd been a founder before. He'd been successful in his previous companies. So he didn't really need the money right away. But as his company grew in scale, there were additional infrastructure costs. So I said, let's think about what your use of funds would be first. Let's think about what you really do need to get, and let's think about what you're trying to achieve here. And as we looked through it, we said, look, you really just need a seed round right now. You really don't need that Series A just yet. Why not go to the angel investors, get the right people on board, and get the seed round closed? And from there, as you get more of the proper metrics to showcase, you can get your Series A at a much better valuation, and you can get the right people involved. And so that's something we talked through with him. Another example of that is an enterprise SaaS company we also worked with. Their numbers were good. And most people ask, well, what's good for a Series A or not? There's no kind of set number, but most people think, let's say, once you break that $1 million barrier, you got something interesting. And that's relatively true, and they've more than broken that. So they've got pretty good numbers. The problem that they had was they were trying to get a pretty large Series A. And the numbers for their revenue, while good, was an enterprise SaaS company metric, but they didn't have anything that tied to some of their really fast-growing numbers, which were their customer base, which is growing exponentially, and also the payment volume that was going through their system. So one of the things that was missing from their narrative was having something from the revenue front that was really tied to that massively growing payment volume transaction and really tying that to why they needed a lot more money to create this moat. And so one of the things we did was to talk to him about what he needed to do in order to tie that story together. And I connected him with the payment processors that were out there so that they can get a percentage of the payment volume going through their enterprise SaaS company infrastructure. And then that actually led to a narrative that shows that the fast-growing customer traction they were getting is going to lead to incredible revenue growth. And the use of funds is to really build up that infrastructure and continue funneling money into it. And one of the things that we talked about earlier around customers, showcasing that your customer acquisition costs are going to lend to future revenue streams that are significantly larger than obviously how much it costs you to get those customers.
Yeah, and I think definitely an adage that is true, which is you as a founder, you will spend what you raise, whether it's 10 million or 20 million. You will, if the money comes in, you will see it go by investing in headcount or marketing or whatever it might be. But it doesn't necessarily mean that it's been deployed in a capital efficient manner. And as soon as you go to raise your next round, investors will be interested in what you did with the last round. So it is very important to make sure that you're strategic around how much you're asking for and that you can use that in a smart and efficient manner to get the most bang for your buck, so to speak, and demonstrate that you can invest it in these value generating areas for your business.
Yeah, and when you're doing the projections and you're talking to the investor about it, they know that these are just projections and forecasts and things are going to change, right? So as long as your projections are reasonable and you can speak to it and you can reasonably show that that number is the right number, it can help give them comfort that they know what you're doing. But from your side, you also want to make sure that you are buffering in enough capital so that you don't get to a situation where things come up that you weren't expecting, it costs you additional capital, and you don't have enough runway to get to the next round or get the traction you need for that next round. So when I was fundraising for my previous company, we went out there looking for a $500,000 seed round, and we knew that we needed probably about $1 million. But we went out there seeking that $500,000. We got it oversubscribed, got to $1 million, and we ended up taking $1.5 million for that seed round. Moved it really quickly, but what we were trying to kind of focus on with that particular raise was we knew that $500,000 was the minimum amount we needed in order to get this product built. We think that $1 million would be enough to get it built with a significant buffer, and so we put a cap actually, and we said if we hit this $1 million and we were not able to get it done, that last $500,000 is not for continuing to do that. That last $500,000 is trying to figure out what to do next if it didn't work. And so we gave ourselves that additional buffer to do that. As we modeled it in and everything else, it was more about how to deploy that and build the business. But you give yourself kind of a number that you think is reasonable based on everything you've modeled out, but you also give yourself a little bit of buffer so that if things go wrong, you still have some capital in the bank to be able to change. And that $500,000 was actually pretty critical because when we realized the unit economics weren't working for the business we were working on, we needed that $500,000 actually to pivot the product, launch a new product, build that into a profitable business, and then get a whole nother round raised.
And that leads us to the next area that we're going to talk about, which is forecasting. And I'm sure Jimmy has seen lots of different levels of sophistication in financial forecasting, as have I. I've seen, early stage companies pretty much run a back of the envelope calculation of what, revenue looks like with a growth rate applied. That's a very, very raw, rudimentary method of forecasting, and I wouldn't recommend it. But naturally, as your business gets more and more sophisticated, so should your financial forecast. But at every stage, when you're thinking about fundraising, you should be looking forward and developing some sort of, financial forecast model to think about different scenarios and the impact on your business that those scenarios may have, whether that's how much capital you raise and how that gets deployed in your business to track through what your revenue growth might look like, whether that, whether you are contemplating launching a new product or launching in a new market, what that looks like as you model out that different scenario. But it's very, very important that you have thought through a forecast and you have something that you can show to investors that is, reasonably built out with a hint of optimism in the medium range forecast in your revenue and your expense items. Now, what we typically see in any financial forecast is, the quintessential hockey stick where revenue growth looks up and to the right. Now that's great and what every founder is hoping to achieve with their business, and quite frankly what investors expect to see for a business opportunity they're assessing. But sitting behind that hockey stick revenue growth needs to be some robust assumptions around what's going to fuel that growth and how much capital it's going to take to achieve that growth. We've talked a little bit about, how that feeds into your ask and use of funds. But one of the other areas that's important when thinking about growth of the business, which I want to spend a minute on, is your unit economics. And so your unit economics is looking at on a per widget basis or on a per customer basis, depending on the type of business that you are. What is the unit, the profitability metrics when breaking your business down to that per widget or per customer basis? Now, we are seeing, and there's been a lot in the press around unit economics, we are seeing a lot more pressure from investors for founders to focus on their unit economics, and rather than scale their business based on top-line revenue alone, we're really seeing now a trend that requires businesses to think about scaling their top-line revenue while also thinking about how that cost structure scales to make sure that they are growing sustainably rather than growing and fueling growth in a product or a service that fundamentally is unprofitable at a unit economics basis. So when you're looking at forecasting your unit economics, you really need to have a focus on optimizing your cost elements of your business as well as growing your revenue to make sure that you are on a path to profitability and you are investing in a product that has positive unit economics. Now, at the early stage of companies, it's not always feasible to have positive unit economics, but we are definitely seeing investors very focused on looking at a forecast and seeing a business that has an opportunity to move to positive unit economics in a short time horizon. So when you're building out your forecast, top-line revenue growth, very, very important to demonstrate that there's a big opportunity there, but also very important to focus on your cost elements and a realistic view of what those cost elements are and how that impacts the unit economics of your business as you scale. Now, in terms of the forecasting, one of the other areas that's important to think about is capital and capital expenditure. Now, this is not relevant for everyone. For example, SaaS businesses is very nominal CapEx requirements, but we worked with a driverless car company. Now, they naturally have more CapEx requirements in their business, and so it's very important to factor in as they develop their technology and are moving towards commercializing it and generating revenue. Are they properly building in the cost elements and the capital expenditure required to get them to that product development and those revenue targets? So while while capital expenditure doesn't sit in your profit and loss, it's still an important element to think about in terms of how much capital you need and where that needs to be invested. Jimmy, did you have anything you wanted to add on the forecasting side of things?
Yeah, absolutely. We've seen all kinds of forecasts. We literally had a client that when we originally started talking through their forecast, they had a slide that projected their revenues. It was a slide, it was a graph, and there was nothing supporting it. And we've also had clients that had investment banking backgrounds come in with pretty complex models, modeling out literally everything. And so we've seen the gamut of things, but you really do want to have some numbers that showcase what it is that you think is reasonable, why you think it's reasonable, because the more background you have here, the more supporting data you have here, as the investors are looking through and doing the due diligence, this is going to be a big component for whether or not they feel like this is the right opportunity for them. Now, one of the things that I also want to relate, and this is something that a friend of mine told me, and I've always kind of remembered it, is he was the founder of Bleacher Report. His name is Brian Goldberg. He and I were having a conversation, and at the time he was starting up a new business. The business is called Bustle. And I said, hey, you got a pretty good round. Congratulations. You know, like what were some secrets? What were some things that worked for you as you were talking about it? And one of the things he said was, look, at the end of the day, the investors want to invest in something that's going to be a rocket ship, a hockey stick. You know, they know that if you can give them the right story that showcases that if you put in $1, you're going to get $10, then it's just about, you know, how much do you really want to funnel into it. And so if you can really just showcase that and showcase how every dollar of their investment is just going to be going to, you know, building tremendous value and forecasting how big of an opportunity that's going to be, that's an easy story for them to understand. And they're going to really love that story, and that's all I gave them, right? The same thing he did at Bleacher Report. If you create the content, you put in $1, you saw that the customer acquisition is X, and ultimately your revenues for every dollar was going to be Y, and Y is, you know, 4, 5, 10, 100x what we spent getting that customer. It's an easy value proposition for any investor to understand. It doesn't matter what business that is. If $1 in gets $10 out, it's a good business for them to get into, right? So just showcase that ability to grow, and if you can show how those numbers work, they're going to be really excited about the opportunity.
Nice. All right. So, thank you.
There's just one last thing I wanted to add. So something that Kirsten started out with was the importance of numbers, and absolutely the narrative really boils down to some of the numbers that you have. And I want to give a quick story about one of the companies that we talked to. It was an Atrium scale company. They'd come out. They were looking for a seed round. I spoke to the founder. They're obviously a little bit earlier than some of the founders we typically work with. But at the end of the conversation, I was so impressed by the founder and what they were doing that I told him that you are absolutely going to raise. Like, I have no doubt, because you know your numbers inside and out. There's just no, I have strong confidence that you as a founder, you've got this Yale background, you've got a great business, your numbers look pretty good, but you knowing your numbers inside and out was what impressed me the most. And so I told him, I guarantee you're going to raise your seed round, you're not going to have any problems, it's just a matter of who. And at the time, he had no offers yet. He went out and talked to a whole bunch of other investors in the Valley, started having conversations. I introduced him to a couple of folks, and at the end, he raised a $2 million round from first-round capital, and he had multiple term sheets. And I think what really separated him from a lot of the other founders that we end up talking to is that he had just such a strong knowledge and understanding of every single number that no matter what it is I said to him, no matter what it is I asked him, he was able to confidently provide the numbers, the backing, and everything around how they came to that.
Cool. All right. Thanks, Jimmy. That was definitely a great way to wrap up this presentation and kind of emphasize the entire point of knowing your numbers, no matter which type of industry you're in. So we're now going to start taking questions. We have about 10 minutes left. So
feel free to submit any questions that you have on the left side of your screen. And if we're not able to get to the questions during the time we have left, feel free to reach out to hello@atrium.co, and we can speak in more detail there. So the first question, what range of money can a founder expect at pre-seed and seed stage? Can you suggest some ranges for technology, SaaS, cybersecurity, and those types of businesses?
So I think the question is how much money you can raise. Is that correct?
Yeah, that's correct.
It's weird because you can see, we've seen all sorts of stuff, right? We've seen seed rounds that are 10 million, and we've seen A rounds that are 5 million. So it's kind of all over the map. But there are pretty standard ones. For a pre-seed, it's usually a pre-seed and probably seed. It's typically up to about $1 million, right? You're just getting started. You just need a couple $100,000 or about $1 million to get started. Sometimes folks raise a little bit more because there was strong interest, but that's typically the range. But of course, there are outliers. And then the Series A, there's kind of that middle area. The seed is typically like a couple million, and the Series A is typically 5 million or more. And more and more, we're seeing Series A that are greater than 10 million. So it's kind of all over the map, but those are general numbers. It really is less about like the exact amount and more about what it is you're trying to do, and also the type of investors and kind of the legal structure that you end up working with. The pre-seed and seed are typically going to be safe notes or convertible notes, and that's pretty easy to get up and running. You can get angel investors involved in that. You might have some early stage investors, but you probably won't have too many term sheets to worry about. It's probably a set term like a convertible note or a safe. And then the Series A is really the first time when you'll start getting term sheets that have different terms to talk about valuations, et cetera.
Okay, great. Kirsten, do you have anything to add there? Can we move on?
No, just, if we go back to Andrew Chen's quote that Jimmy mentioned at the start, it's less about the amount raised and more about the stage of the business that kind of supports what you call the round. But there is no hard and fast rule, I would say.
Yeah, makes sense. Okay, so the next question we have is, let's say the total addressable market for a company is already really large. Let's think like 1 billion and above. Does that mean that the market is already taken? Can you speak to that a little bit?
Yeah, I think my favorite quote here, that thinks about total addressable market is from Henry Ford, when he said, if you ask the people what they want, they would have said faster horses. And obviously what he actually developed was the automobile. So while, yes, competition and the existence of a large addressable market demonstrates that there's probably competitors and incumbent players in the space, definitely don't be deterred by that, and think about your solution. In terms of your solution, think about switching costs and value to customers. So when I talk about switching costs, I mean, what is it going to take for, let's say, incumbents already or customers already using an incumbent product in your space? What's it going to take for those customers to switch from what they've got to your product instead? And then the second component of that is, what's the value proposition of your product relative to existing products in the space? So, is it faster? Is it cheaper? Is it simpler? They're just some examples of how you would think about positioning your product relative to existing products or services or competitors in a TAM. But just because there's, a problem and solutions already addressing that problem doesn't mean you should be deterred from playing in the same space, as long as you understand customer switching costs and value proposition of your specific product relative to others.
Yeah, I completely agree. I think it really is just boils down to what it is your story, what is your narrative, right? So for this particular question, Dropbox is a great example, right? When Dropbox came out with storage storage wasn't new. Everyone had all kinds of different solutions. Microsoft had tried that. And so when they came out and just said, hey, it's storage, it's like, well, that's not compelling or interesting. But what was compelling and interesting are really some of their other metrics around the attachment rate once people were actually using it, how easy it was for someone to utilize this kind of cloud storage, which completely changes how people actually interacted with cloud storage. It just wasn't easy before. And so it was really that ease of use that was the metric that got people into it, which allowed people to keep using it, which drove up the customer adoption. So it's stuff like that that is really part of the narrative that showcases why this is a large opportunity. It's not like, hey, storage is huge and there's a lot of money here, and there's a lot of competitors, so there's no opportunity here.
Cool, yeah. Thanks, Jimmy. Thanks, Kirsten. So we're moving on to our last question now as we're coming up on time. So should you tell a story, talk about the history of the company in a pitch deck, or should you just focus on the value to the investor and the metrics?
I think so Justin Kahn, our founder, has a number of great blogs and content available around the importance of a narrative. And I think that's, I would encourage everyone to look at that content. Your narrative as a founder is so important. And the numbers component really just support the narrative. So if you think about telling the story of your business, your pitch deck is your tool that enables that story to be told, and your numbers are part of the supporting documentation or supporting resources that really underpin the narrative. But as a founder, fundamentally, when you're talking to investors, you should be following, telling your story and using these things like your pitch deck and your numbers to support that story. So I wouldn't think about pitching or presenting to investors in terms of just, data-driven points. It really is about the story that you're building, and being able to quantify that to provide strong evidence that what it is that you're building is a viable opportunity. Now, the later, again, if we go back to that kind of breaking down the stage of the company and what investors are really thinking about at each stage, the earlier stage you are, it's going to be less about the numbers and more about your team and the market opportunity in that narrative. And then as you get later stage, it's going to be more focused on how much the numbers really support that narrative in terms of your traction, your market opportunity, your customer trends, etc. So really think about the numbers as the supporting resources to complement the story that you're telling.
Yeah, absolutely. And I think every slide that you have needs to be a strong selling point. Otherwise, it shouldn't be part of your overall narrative. And we do have a lot of information around how to build a really good narrative. So I encourage you all to take a look at that. But to Kirsten's point, as you're talking through what your overall story is, I think the numbers are really that key support for you. And it's not about one or the other. I think they work together in tandem to build the best narrative possible. And some of the background may be helpful, may be useful, but I would make sure that if the background is useful and helpful and a huge selling point, then include that. But the background is you building 3 other things that didn't work and you had to pivot to this. It may or may not actually be a selling point. So it may not be something that's important as part of your narrative, but the numbers that you have will help support whatever it is that your overall narrative is helping to provide for the investors to persuade them to invest.
Okay, great. Great note to end off the presentation on. So like I said, if you have any additional questions, feel free to reach out at hello@atrium.co, and we can get them routed to the right people. Thank you to Jimmy and Kirsten from the Fundraising Concierge team for presenting today. I hope you all enjoyed. We'll be sending out a recording of this webinar overlaid with the slides in the next couple of days, so look out for that email as well as any additional resources that Jimmy or Kirsten referenced during this presentation. Thank you. Have a good one.